Hello and welcome back to another episode of HKEXVoice, our podcast featuring insights from HKEX's executives and industry leaders on topics relevant to Hong Kong's financial markets. I'm your host, Jeffrey Young. HKEX launched its first A-share derivatives product based on MSCI China A50 Connect Index on 18th of October, and momentum has been building solidly ever since. As we approach the 1 month mark of its launch, we are very delighted to welcome here with us Kevin Rideout, HKEX co-head of sales and marketing, to talk about the performance of this product and how it is by far the best A-share futures product to help global investors manage their Chinese equities exposure. Welcome to our podcast, Kevin.
Thank you. My pleasure to be here.
So, Kevin, we're just about to celebrate the 1 month anniversary of the launch of this product. What are some of the key milestones we've seen so far?
Well, I think, first of all, Jeffrey, it's been a long time in the making to get to this contract. So I think there was an air of optimism. But with the optimism, I think you've got to sort of complement that with a systematic approach. And the first thing that you really hope for is a stable order book. And that was achieved incredibly quickly, I think to many people's surprises, but perhaps not to our own. So I think once you get that stable order book, it actually creates the environment where assets can start to place themselves. And so the next thing that we saw were actual real money open interest being placed into this contract for many reasons, which we can get into later. But we also saw the launch of 4 major ETFs in China, and hopefully there'll be more around the world. So when you get a stable order book, you can add in the assets to it, you start to build that ecosystem. You start to build those chemical reactions. And then you see the other players come in. The size is now big enough that long-onlys can come in, hedge funds can have a look at it, quant funds can come on with it. Then you go to a newer paradigm. And I suspect in the early part of next year, you'll see some additional liquidity events that are just going to mature this product faster than, personally, I've ever seen any other futures product mature.
So can you give us a sense of the performance of the product so far in its first 4 to 5 weeks?
Yeah, look, I think the headline grabbers are there, right? There's been days where I think $1 billion now per day in notional of ADV is becoming, touch wood, is normal. Obviously, we want to go higher and higher, but really critically is you must look at that stable open interest. And the stable open interest right now is well over $2 billion. For something, as you said, has only been around for a few weeks, to get that level of open interest is unprecedented.
Yeah, that's amazing. When it comes to managing A-share exposure for international investors, how do you think this product would be the first choice for them?
Yeah, look, I think, as I said earlier, Jeffrey, I think we took a long time launching this, right? And it's been consulted with all the major clients around the world on what they would like to see as an A-share future, as a China hedging tool in the offshore market. And there were 3 key pillars. And I'll go back to being British. I have a Bachelor of Science, a BSc. And those are the 3 letters I think thematically come through from every single client. The B stands for broad. They wanted a broad-based index, one that represents the new China, if you will. I mean, appropriately, there are other contracts out there that were fit for purpose 15 years ago, when older economies like property and banking and finance, etc., were the dominant from a market cap perspective. But anyone that looks at China today sees these wonderful technology companies. They say a booming healthcare industry, a booming biotech, and the service industry. Plus, there's, China's one of the most really forward-thinking in the clean energy space. And so how do you capture that? And so that's why the broadness is important. The second is the S. Well, look, China's the world's second largest economy, right? That's not the S. The S stands for the size of the contract. This market respectfully needs an institutional size hedging tool. So the size of the contract is 4 to 5 times larger than other alternative offshore A-share future contracts. The third pillar is the C, and there's actually a few C's. C is correlation, right? So I think most eyes these days in terms of a definitive benchmark of China would probably look at the CSI 300, a much longer, broader-based, again, sector-orientated index. In the offshore market, you're always going to have your futures contract correlated to that onshore contract. So correlation was a big thing for us. And so just naturally, if you're going to go sector-based and you're going to go respectful to the China contract, you're going to have a high correlation to the Chinese economy. And the contract that we have is high 90s, 96, 97% correlated. So those are the three little letters, Jeffrey. Bachelor of Science, BSC, broad size correlation.
Yeah, I think I'll always remember that, BSC. Thanks, Kevin. There's a lot of talk in the market about how this product reduces tracking error as compared to other similar products in the market. Can you illustrate this with some examples?
Yes, certainly. It's actually tracking error is in direct correlation to, strangely, correlation. So if a contract is highly correlated to the onshore CSI 300 and your fund is tracking the CSI 300, it stands to reason that a higher correlation will mean a lower tracking error. We've seen shifts in policy risk happening episodically and idiosyncratically, as a risk manager would tell you. Because of the nature of this contract being sector balanced, it's not very sensitive to policy risk. So if the attention of the day right now is around reforming the property sector and the banking sector and the finance sector, because it's not market cap weighted and it is broad, it's always going to maintain a high correlation. And it's always going to reduce tracking error, and it's always going to be less sensitive to policy risk. But it's actually the lens that you would look at from a tracking error is really one of that from a portfolio manager and a buy-side institution. Mm-hmm. You would also look at performance. So the performance of this contract and the tracking error are both positive versus any other offshore A-share futures contract. 5 out of the 7 years, this contract in Hong Kong has got a more positive Sharpe ratio than other contracts in the offshore center. In the 2 years where it wasn't quite as positive, it was par. So if you're a risk manager, you're going to be thinking about how do I defend policy risk? How do I keep low volatility? How do I keep the Sharpe ratio in a positive sense? Well, you know, this really works well, and it's not sensitive to policy risk. As I said earlier, whatever mathematical equation you want to throw about this, Sharpes, Altmans, correlation, performance, policy risk, tracking error, whatever financial algorithm, whether you're a risk manager or a portfolio manager, Delta One trader, this is going to work for you. And that's why the open interest has gone to where it has so quickly, because some of the calculations are just so obvious.
Well, that's fascinating. So Kevin, how would MSCI China A50 Connect index futures complement the other offshore China product offerings on HKEX at the moment?
Oh, look, it's certainly, as I say, it's a massive headline grabber, but it's actually just a very natural step in the evolution of offshore China. Actually, Jeffrey, the first step in that direction were 8 shares. Right, so right. Qingdao in the 90s. Right? In the 90s, Qingdao beer, really, really tasty. So that was really the first step in that direction. And when the 8 shares started to become quite prolific, we ended up seeing the formation of the HSCEI, the Hang Seng China Enterprises Index. So that was a natural step, right? Then we saw, fast forward a little bit further, you see the launch of Northbound Stock Connect. And we've seen that being incredibly explosive. We've got 2.6 trillion renminbi of assets under custody in the space of 5 years. We've created a new Hong Kong exchange through the Connect program in the space of 5 years. This is how explosive the appetite for China A shares is. So we also have further China flavors in the offshore market. Now, we have another contract called MSCI China, which is not the China A. This is the broader China. This is a very broad perspective of China. So this would include the ADRs, this would include the H shares, and it would include the A shares. Now, if you wind back to what I said earlier, you've got the HSCEI, the H shares. You've now got MSCI A50 Connect, the A shares, and you've got the broad view. So whatever view you want to take of China, do you want to take a global view of China's footprint? Do you want to take an onshore view of China's footprint? Do you want to take an offshore Hong Kong view of China's footprint? You got the HSCI, you got the A share, you've got the broad global China. Now, you might like the H share story, so you go long H share. You like the A share story, you go long A share, but you may not like the US ADR story, who knows? So you can go short MSCI China, and then you've effectively become short the ADR. So I'm not telling you what to do, but I do know that the client base enjoys that flexibility to express their view of China. Now, the other thing is, if you are long into China, into the securities story, do you still want to be long in the renminbi if you're reporting back in US dollars? There's a hedging need. And that's where the currency futures can come and play a role. And we've seen that starting already to a certain extent. So add it all together, express your view of China any way you want. We have all the tools to do that. Hedge however you want to. And this is before we get into the single stocks and the ETFs and everything else. But this is the chemical reaction laboratory of China.
Kevin, I know HKEX is working on a number of projects to make our market even more attractive to international investors in terms of market microstructure enhancements. Could you tell us about some of these and how they'll actually be attracting more customers to our market?
Yeah, look, I think that's a great question, Jeffrey, and it's when we took the MSCI sweep from Southeast Asia, it's getting up for 18 months ago. What it really did, it actually said, you're now in the Premier League. You're now on the global stage. And respectfully, we've been having a wonderful time with local/regional products. Now we've got global products. And that's a very different game. I often liken it to the English Premier League, and I know it's well covered over here. When you come up from the Championship into the Premier League, you shouldn't expect to win the Premier League straight away. You're going to have to bring in new players, new stars, and start forming. And it's a little bit similar to this. We're now in the Premier League, and we're staying there. Now we've got to go up and try and win the league. And so what does that mean? Our players are our platform. There are some critical market structure changes that we need to make on our journey to the ambition of being Asia's risk management center. Now, one of those is managing event risk. And what do I mean by that? Event risk is where you might have some news or policy risk change, tax change, legal change, overnight news, and you can't place your hedge because your market is shut. Right, so particularly important for countries where India, for example, or China, which have got massive exposures, for us to be shut when those underlying markets are still open, well, that's not going to win you the Premier League. And that's why we've done the consultation very recently on holiday trading. Again, client-focused reaction and response to the request of the client base, and so very positive. In the not too distant future, we'll address holiday trading. And that will be ensuring that if you want to be a risk management center, we no longer have to sort of worry about event risk. We'll be open in time to respond to anything that you want to respond to. It's not the end of the journey. That's like getting a good goalkeeper. Now we've got to think about the midfield and the strikers. And so what do I mean there? One of the things that you think about in terms of a net total return type of contract, one that is a longer term holding and exposure, is the cost of holding it there. So it's very important that we think of ways to make our capital requirements for the MSCI suite in particular much more efficient in comparison to our global peers. But most importantly is we do have the ambition to be the most risk-balanced, capital-efficient market for managing your risk in Asia. Then there's going to be tweaks around what I'd call the velocity client base, meaning folks that like to trade in and out a lot, respond to sort of micro events, if you will. That's going to mean things like early opening or early closing or the tick size or the spread book, whatever it's going to be. So I'm actually pretty amazed how far we've grown up in the Premier League in the last 18 months of having these contracts. It's it's an incredible testament to all of my colleagues across the exchange. I think the amount of effort and work has gone in from all corners of the exchange, whether operations, legal, corporate communications. I mean, it's just been a very united approach to being successful here, and I look forward to lifting that Premier League trophy one day.
Well, Kevin, thank you so much for joining us today. We've learned a great deal about how this new product, helps provide higher correlation to broad China A share benchmarks, enabling global investors to better manage their A shares exposure. Thank you, Kevin.
Thank you, Jeffrey, and thank you, everyone.
For all our new listeners, if you want to learn more about this podcast or HKEX's offshore China derivatives suite, please visit our website at hkex.com.hk. From all of us here at HKEXVoice, thank you for listening and keep an ear out for our next episode. So long.